There was one insurer
that
who
had zero
discounting.
upfront discounting completely, and it
so
was really easy.
If you took out a policy at 40 and then you held it until 45, and whether you were a new policy holder at 45, you were being charged the same premium. So no discounting. But what happened?
They decided to jump on board with the rest of the insurers and start offering upfront discounting.
Yeah, and pretty significant. They became the second worst.
Yes.
Yeah, they're the second highest discount in the market. And there's nuance in this, but, actually the worst in terms of the initial discounting and the way they've structured it.
Yeah.
Hey there, welcome to one of our Skye Deep Dives. Today with me, I got Nat King. Thanks for joining me, Nat.
No worries.
So Nat's one of our provisional advisors at Skye and who led this project about the topic we're going to talk about. So we're going to be talking about duration discounting. So, Nat, start us off. What is duration discounting or initial discounts?
So durational discounting is where the insurers offer a lower premium when you sign up to take the policy, but then they slowly increase the policy every year because they've discounted it in year one and they take a little bit off over time.
Yeah. Cool. So talk to me about why does this happen?
So when you put your policy into force, you usually go through a process of underwriting. So the insurer asks you a whole bunch of medical questions about what's been happening in your life, as well as any current medical conditions happening. At that point in time, the insurers have the best understanding of your health and any risk that they are facing by putting a policy into place for you. As that time increases, so in year 2, they don't know what's happened in that 1 year since your policy's been underwritten, so they have to make that risk assessment.
Yeah.
Then the other reason is the way the insurers put it. Everyone does it, so we have to do it.
Yeah. So the underwriting is risk-based assessments, which they do. A male will be charged a different premium than a female. Yeah. So they're doing risk assessment pricing anyway all the time. Having your policy for 10 years, the way life insurance policies are set up, they can't make any changes to your policy once it's already set up. So the way they manage that risk is increase that premium over time. And so that's the kind of the most the best way to put it, and the way the insurers put it. The other way is, as you said, competition. So so majority of policies are recommended by advisors based on the bottom 3 cheapest premiums are the ones that get most market share. So if everyone else is, if Macca's and Hungry Jack's are discounting their hamburgers and doing 50% off, then the other hamburger places, are there any others?
I was about to say KFC, but KFC's chicken burgers.
Yeah, okay, KFC will have to do a 50% discount on their burgers.
Yeah.
And they, to be honest, they do that. Like they're loose change things. Like they all have these low cost things. So that sounds good, doesn't it? We're getting a discount. So talk to me about the research project. What do we do and why did we do it?
Cool. So I think I was in week 1 and you were like, hey, Nat, I want you to do this project. So I started off by just running an initial quote with all of the insurers for someone age 40 and then what that policy looked like when you would put it into force versus someone in age 50 and what that would look like at that point in time. Now, we then looked at the projections behind, so if this policy costs this much now, what's going to cost next year, the year after that, blah, 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 continue on, all the way to age 50. We got some varied results back and some insurers, so I started off trying to make it really simple and really basic. But some insurers don't offer things like, it's called variable premiums now, but I say level premiums, but that's all changed.
Yeah.
And so then I had to go to the BDMs and be like, hi, I'm Nat. I've been at Skye for like a whole week. And now I'm going to ask you all of these questions about upfront discounting. And then when you don't give me an answer because you're not going to, here's Phil.
Yeah. Yeah. So, the research project is, so you did a quote as a 40-year-old.
Yeah.
And then you did a quote as a 41-year-old.
Yep.
Then you did a quote as a 42-year-old, 43-year-old, all the way to 50. So we did 10-year span.
Yep.
And the base premiums, the 40-year-old quote, we got the projections over the next 10 years of the premiums.
Yeah.
And we went, okay, as a 43-year-old, if we set up the policy as 40 and we kept it, what's the price difference between that premium versus a new 43-year-old going through underwriting?
Yeah.
So having that risk assessment from the insurers to be a cheaper premium. So give us an understanding of what so there's a mountain of work. So appreciate doing it. And why, talk to me about why we actually had to quote it that way instead of just looking at a quote or looking at a premium projection and just knowing what that discount is, because the insurers don't disclose it.
Yeah.
That's the answer. The insurers don't. It's transparent in the fact that they will tell us what the premium projection will be. So there's no lying, there's no malice, well, there's no they're not trying to misrepresent their premiums because it's in the quote. The thing that isn't in the quote is what is their internal discounted rate.
Yeah.
Most of these actually, I'll ask you how many insurers are disclosing these initial discounting and how many are not?
Less disclosing than not disclosing.
Yeah. So some insurers will say on their quote, the premiums have got a 25% discount and they will come off over the next 4 years.
Or even, hey, we've got a discount, but they won't tell you what the discount is.
Yeah. Yeah, and that'll taper off over the initial discount or duration discount will come off. Some just bake it into their premium projection, so it's actually really hard. And one of the things that, for anyone out there watching, it is very difficult body of work. I don't know any other advisor who's done this amount of work in the duration discount stuff, because I mean, how long do you reckon it took you?
A couple of weeks.
Yeah.
I think I was here for a month before I was like, all right, cool.
I get to do something else.
Can I do something else now? And then there was a plot twist.
Yeah, exactly. So there was, let's touch on that plot twist. There was one insurer
that had zero
discounting.
Upfront discounting completely, and it was really easy.
If you took out a policy at 40, and then you held it until 45, and whether you were a new policy holder at 45, you were being charged the same premium. So no discounting. But what happened?
They decided to jump on board with the rest of the insurers and start offering upfront discounting.
Yeah. And pretty significant. They became the second worst.
Yes.
Yeah, they're the second highest discount in the market. And if there's nuance in this, but actually the worst in terms of the initial discounting and the way they've structured it.
Yeah.
So we did a huge deep dive. A lot of advisors, because we try to be as loud and public about it as possible within the industry, because we want to, at Skye, we want to make sure it doesn't happen. It's not good. I don't love it. And so we try to be loud about it. Advisors knew it was happening, but not to the extent that it was. Yeah. And so it's been really positive. There's, insurers actually don't like it as well.
No.
They do it because they feel like they have to, but they don't feel like it's a sustainable practice as well. So now let's touch on, why isn't it good? If I'm a customer, I'm getting a discount. Why don't I want a discount?
Well, if you get a discount in the first year, fantastic. You've saved money this year. Next year, you're a year older, so your premiums are likely to go up next year because of your age. But they're also going to increase because of this upfront discounting. There's going to be a small portion that drops off. In 10 years' time, you're 10 years older, and even more of that discount's gone, and your premiums end up being not what you expected them to be, because there's been a 25 or a 31% jump in the premiums, but it's also increased by your age every year. So it's so skewed of, cool, I'm expecting this and it's going to stay the relatively same. Just like car insurance, it does increase every year, but it's not increasing by 25% in 5 years' time.
Yeah, there's a baked-in 25% increase. And I mean, we can just touch on that. Like one insurer is less than 10%.
Yep.
Which is great. There are actually, let's just touch on what's the discount across the board?
I think the average kind of sits between that 20 to 25-ish percent across the board. Like you said, the lowest is 9. The highest based on the project was about 38%. That is a little bit skewed. They do give a lifetime discount, so based on how old you are when you take out the policy. So that is slightly skewed, and it's more like the 28% mark for that.
And the reason why it's skewed is because if you take out the policy at 50, you get a higher lifetime discount.
Than if you took it out at 45.
Took it out at 45. So it is baking in a discount, even though some of the discount is lifetime. But yeah. So yeah, we got 9% is the lowest. Next is 20. Next is 22, 22, 25, 25, 27, 28, 31, 38. And talk about the drop off. So some drop off over 10 years plus.
Yeah, so some drop off over 5 years. Most drop off over 10 years. So it's not until 10 years from now that you see the effect of that discounting fall off your premium. Some, I think there was one that was 7 years or 8 years. I've got it here. Or 5 years for one, and then 6 years for most of the others.
Yeah. And I mean, one thing that was encouraging, yes, one insurer came out and said, hey, we're adding it, because we gave them a big shout out that they didn't have it, and then they just added it, which is good fun. And then one actually came back to me and said, hey, can you update your post on LinkedIn, because we've actually reduced it. We've reduced our discounted, so it's a much flatter premium increase, which was encouraging to be, because. And the reason why it's bad is because if I buy a drink bottle, I am buying it once. So if a retailer is going to discount it 50%, great. I don't ever need to buy this drink bottle again, potentially. Or if I do go and buy it again, then I've got a choice of going, well, now this is at full price. Your drink bottle may be 50% off.
Yeah. So
I'll go and buy that. So discounting, is normally pretty good for consumers. It's a great option. When it comes to the insurance and life insurance especially, it's really difficult to transfer to policies, to move providers, because you've got to go through this underwriting process.
Yeah.
So that's the major issue I have with it, is that it's inadvertently telling consumers that premiums are actually this much, but really their base core premium is much higher.
Yeah.
And the only way they make money is to have this baked in loyalty tax, as we know. And it's similar to going and getting a home loan. And if the home loan interest rate had baked in to increase, and let's say it was at 4% today, but you hold it until until expiry, or until you pay off your loan, and it's actually ends up being 10%, then we wouldn't be that happy if it was like baked in. But home loans are, you're often, over time, it's easier to move because your income's going up, your debt's going down. So it's actually easier. So if that happened in the lending space, it wouldn't be that bad, because
just jump ship, go to a different bank.
you move over, because as I said, these factors are better. When it comes to life insurance, it's the opposite. It's theoretically harder to move as you get older because of health events. There's a whole bunch of reasons why we got to be cautious moving, because you may get an exclusion. So that's why I'm hugely against duration discounting, and think it's I'm vocal and think it's a scourge of the industry, because we're telling our clients it's $1,000 premium, even though
it's really more.
It's $1,300 or whatever it is baked in. Yeah. So. Is there anything that we missed about duration discounting that you think we need to touch on?
I had a chat with one of the BDMs in my first week, and he was like, well, why don't you just turn off the discounting and just offer the premium without the discounting if you're so worried about it? And the reason that we can't do that, and you've probably got thoughts on this one as well, is then they suddenly become one of the more expensive insurers, and we're recommending someone that's more expensive than someone that's offering the discounting, even though in 10 years' time, potentially, they could be the cheaper insurer.
Yeah. And I mean, don't set me off. You're about to.
Whoops.
But I mean, the other thing is, like, at the end of the day, insurers do come at advisors and say, well, we have to do these discounts because you recommend them. And I understand that that's a legitimate concern. And I look at it and go, we have to recommend the discounted product because there's a few reasons. Because if you're a customer and I said, oh, look, this is 50% off, and you're going to have to buy it every year, but today it's 50% off. In the future, it may be higher. Buy this one, or I could sell it to you full price today, knowing that you're going to have to buy it every single year at full price. You'd still want the 50% off today, even Absolutely. Though I know next year it's going to be full price. And so we want to look at a long-term premium for our clients, and we do look at long-term premiums and going, who is going to be long-term more sustainable? But we can't just turn off a discount because we're effectively getting our clients to pay more for an insurance policy with no upside to it. And so, that is a frustration. And we get paid a commission, and our commission is based on the premiums. So if we are artificially increasing the premiums, we're artificially making more money from it, which there's a whole bunch of compliance concerns about. Well, is that in the best interest of the client?
Not only compliance, but ethical as well.
Well, ethics and compliance are all the same thing in my mind. All I think about is jail. Don't go to jail. And so, there's all these complexities when it comes to advice about making sure we're doing the right thing by their clients and trying to be as vocal about getting the insurance market to come down, because this is a new phenomenon. It hasn't been around forever. Insurers have just deciding that how do we not ruin our whole business by giving cheaper premiums forever? Well, we'll do it for 4 years. And that's a big issue. Anything else I missed?
I don't think so.
All right. Awesome. Hey, this has been really good. If anyone does, we might put a link to like my LinkedIn article, because I did a funny video. Did you watch the video that I made?
Probably.
So have you watched The Office, the American Office?
Yes.
So there's a scene where they're all doing this, like fake guns, and it was like basically going like we're all in this like gunfight where
we're all stuck.
The insurers are pointing the guns at the advisors, and they're pointing the guns at the regulators. The advisors are pointing the guns at the insurers and the regulators. The regulators are pointing the guns at the insurers and the advisors, and we're all like kind of this like standoff going like no one wants to do anything wrong or improve the whole thing, and the clients are in the middle of the gunfight, being worse off. So anyway, we'll put a link because we do actually name the insurers, and we do show their discounting, and so we can put a link in the description to this video about that.
You got to update it first.
I do have to update it because we gave the one insurer a big raving review about not doing it. All right, awesome. Thanks, Nat.
Thanks,
Appreciate it.
No worries.